Today is May 4th, 2023, and man, do we have a lot to talk about in real estate today. This market is on fire. The two main issues I want to address today, though, is that one, when the feds raise rates, that does not mean that interest rates are going to be rising for mortgages. And second, why a recession does not equal a housing crisis. I have spoken with two real estate professionals over the last week, and I was shocked when both individuals proceeded to tell me how this week mortgage interest rates were going to rise because the Fed was raising rates. Actually, this week, rates have come down, and yes, the Fed raised their rate. The first thing to take into consideration is that the Fed rate is a short-term rate. This is more correlated with your credit card interest rates. The mortgage rates are based on a long-term economic outlook. And in some instances, we see the Fed raise rates and mortgage rates come down because the investors look at this as in the long-term perspective. So they may focus on more what the Fed minutes say than what they do with the interest rates. Now that we have all that out of the way, let's talk about the real buzz going around about a recession and what that historically means for real estate. Everywhere you look, people are talking about a potential recession. And if you're planning to buy or sell a house, this may leave you wondering if your plans are still a wise move. To help ease your mind, experts are saying that if we do officially enter a recession, it'll be mild and short, as the Federal Reserve explained in their March meeting. While a recession may be on the horizon, it won't be one for the housing market record books like the crash in 2008. What we have to remember is that a recession doesn't always lead to a housing crisis. To prove it, let's look at the historical data of what happened in real estate during previous recessions. That way, you know why you shouldn't be afraid of what a recession could mean for the housing market today. Most people remember the housing crisis in 2008 and think another recession will be a repeat of what happened to housing then. But today's housing market isn't about to crash because the fundamentals of the market are different than they were in 2008. Back then, one of the biggest reasons why prices fell was because there was a surplus of homes for sale. At the same time, distressed properties flooded the market. Today, the number of homes for sale is low. So while home prices may see slight declines in some areas and slight gains in others, a crash simply isn't in the cards. A recession means falling mortgage rates. What a recession really means for the housing market is falling mortgage rates. As the graph shows, historically, each time the economy slowed down, mortgage rates decreased. Bankrate explains mortgage rates typically fall during an economic slowdown. During a traditional recession, the Fed will usually lower interest rates. This creates an incentive for people to spend more money and stimulate the economy. It also typically leads to more affordable mortgage rates, which leads to more opportunity for home buyers. This year, mortgage rates have been quite volatile as they've responded to high inflation. The 30-year fixed mortgage rate has hovered between roughly 6 to 7%, and that's impacted affordability for many of our potential home buyers. But if there's a recession, history tells us mortgage rates may fall below that threshold, even though the days of 3% are well behind us.